great panel here just to discuss and pick out some of those key themes. We've got Kim Politzer, we've got Tobias Schultheiß, we've got Jim Costello, we've got Andy Watson, and we've got Tom Leahy. Let's just start with some brief introductions before we kind of dig straight into the topics. Kim, let's start with you. Just a brief introduction of yourself and Fidelity, please.
So I'm head of real estate research at Fidelity. We have about 2 billion under management across core European markets in the UK, and our capital base is pretty global. We're fundamentally core plus investors, and we've been active particularly in things like life sciences and logistics, like many other people over the last year. And probably have been underweight to retail for 4 or 5 years now.
Okay, super. Thanks very much. Jim.
I'm Jim. I'm with Real Capital Analytics. We are a global property information firm helping investors understand capital flows and asset pricing worldwide. I'm in New York, here in Brooklyn, weathering COVID, and I'm looking a lot at what happens in the Americas.
Perfect. Thanks very much. It'd be really interesting to get your take on what's happening in the Americas, Jim. Andy.
I'm speaking to you from Paris, where I have lived and worked for 27 years, approximately half my life. I work for Europa Capital, who are a pan-European investment manager, 75% owned by Mitsubishi Estate Company, so giant Japanese investor. Europa has a 25-year track record, mainly in the value add segment of the market. But recently we have launched a core fund, as Mitsubishi did in the States with great success. And I am running that out of my office in Paris.
Super, great, thanks very much. Tom.
Afternoon, everyone. Tom Leahy, also from Real Capital Analytics. So there's 2 of us this afternoon on the panel. So Jim's focus is on the US, whereas mine was really on Europe, with a bit of a global slant as well, but focusing on our European data set and analysing those trends and communicating them to our client base.
Super, thanks very much. Tobias.
Yeah, hello everybody. Thank you, Richard, for setting this up and allowing us to have a MIPIM similar thing to this afternoon. My name is Tobias Schultheiß. I founded Blackbird Real Estate some 10 years ago as a transaction advisory boutique, which is still our core business. We have now offices in Frankfurt, Munich, and Cologne. We are headquartered in Königstein, which is 20 kilometers north of Frankfurt. As I said, focus is transaction advisory, but we also do set up joint ventures with selected partners nationwide. And almost 4 years ago, we started setting up our buy and hold small properties in secondary locations program. So that's basically what we do.
Perfect. Thanks very much, Tobias. Andy, I just wanted to maybe start with you. In terms of the capital flows and opportunities, interest rates obviously play a part in that. It looks at least as if they're set to remain low, so therefore low bond rates, volatility expected in the equity markets. So do you still see a kind of increased allocation to real estate for global capital? What's your sense of that?
My sense is absolutely yes, and I think that the low interest rate environment, the premium on income, which obviously property can do that others can't, and income is a strong commodity, but recurring stable income is actually a precious commodity.
Just in terms of that, I mean, Jim, in terms of the US, there was a lot of discussion about maybe interest rates increasing, what's going to happen there. What's your sense of that, and is that likely to drive some of the sort of global capital moves as well?
Yeah, there has been some upward pressure for interest rates. And some people look at that as a drawback to real estate, but the forces driving it can actually be beneficial to that precious commodity you're just talking about, recurring income. The only reason interest rates are going up is because there's some sign of economic growth, a little bit of inflationary pressure in the economy. Now, inflation is tricky. You want some, but not too much. So it's the Goldilocks and the three bears. You don't want the porridge that's too hot. You don't want it too cold. It's got to be just right. And if we have that economic growth, that helps drive income, we'll be okay there if interest rates go up. If they go up because of some sort of stagflation type of environment, we'd have a trickier time. But this recovery period we're moving into, with some signs of economic life, helping to drive some further demand for real estate and some better improvements in property income for real estate, I think it could be beneficial.
I tend to agree with both what Andy and Jim have said, that that interest rates are likely to stay low for the foreseeable future, and people are going to be continuing to invest into real estate because of the income that it offers, and that stable income in particular. And I also agree with Jim. We did some work where we looked at how property performs under different combinations of inflation and growth. And yes, in an inflation and growth environment, property does very well because you've got real momentum in the market driving demand. But in a situation where you have inflation and no growth, real estate actually does really badly. And it's a really poisonous combination. Now, for European real estate, where you've got some indexation, you get a little bit of benefit. Your income is indexed, but of course you end up with a situation where you have significantly over-rented assets at the end of it, or assets that occupiers can't afford to be occupying. So we do have to be aware that there are risks if we don't see the growth coming with the inflation, even where we've got indexation in our leases.
Okay, good. I wanted to pick up with you. I'll come to everybody in terms of their views on some of the capital flows. But just coming to you, Tobias, what have you actually been seeing there in Germany, particularly in the sectors you're in? Are you seeing more domestic capital? What have you seen over the past kind of 12 months? And do you see any sign of that beginning to change at the moment?
No, actually, this will be at least my impression will be a boring answer, because it's a 50-50 thing. We as a company, we had several transactions that we brought to a closing last year on a 50-50 thing, where 50% were domestic investors, 50% were international investors. And when you look at the research of the big consulting firms like Savills, CLL, you name them, they also come up with this figure. So it's and this is, to my impression, the long-term average, more or less 50-50 thing between international and domestic investors. On the other side, I see a lot of investors that want to come to Germany and want to spend money into German real estate, but they just cannot because of the pandemic. And there are some that could fly into Germany, could have a site visit, but they are not prepared to fly back and stay at home and quarantine for 2 weeks. So there's a lot of money waiting to come into Germany, which just can't right now.
And from your point of view, Tom, is that really showing through in the figures in terms of what you're seeing?
Yeah, good question, Richard, because we looked at that for our 2020 Europe Capital Trends report, and there was a correlation between markets that were more domestically focused tended to hold up better through the post-pandemic period than those that were more oriented towards cross-border markets. So places like Spain, Portugal, Poland saw a much larger slowdown in real estate investment in that period from April onwards. So really this time last year onwards, when the pandemic started to affect all our lives. Whereas the outliers in terms of the most domestically focused markets were Norway and Switzerland, and those saw quite strong growth in investment actually in 2020. So that does seem to suggest that there is a link there, and you'd say it's probably causal, given that the restrictions on travel that are affecting all our lives. You want to see the building generally before you buy it. So that's definitely borne out in the data, yes.
Yeah.
Just to mention, and thank you, Tom, I agree with you. Just an example I had last year, there was a German investor who wanted to buy a property, but he could not because he did not get out his advisors, the technical due diligence guy, the valuer, they were sitting at home and saying, no, I'm not leaving your house. But it's not only an international or domestic thing, it's also a national thing.
It is a little different in the United States. The cross-border money here fell at about the same pace as the domestic money. So as a share of total, it was constant throughout the crisis to, sort of what it was beforehand. Part of that, though, is that if I'm a cross-border investor, a lot of them have staff already situated in the United States. So there's, if I'm in Germany, I can easily, go into France or Italy, a very short period of time. Can't go to the United States so easily, so maybe it makes sense to have a team in someplace in the United States. So there's a bit of a difference in that. It was easier to get around here since you didn't have to cross so many borders.
And Jim, just whilst we're on the topic of the US, there's obviously been a changeover in terms of the administration with the Biden administration coming in. Is that something we would expect to see changes, both whether or not that's investment coming from outside the US in, or a change from US capital heading out?
I don't think so. It's the Biden administration. They've been getting a little bit of grief in the press over here over the last week, and that they aren't making noise. They're purposely trying to be a very boring administration and just focus on just governance and not making everything about them. Just trying to get things done. So it's not as if. It's not the noise that was around in the last administration. So in terms of policy things, they're just focused on dealing with the pandemic first, getting everything out of the way there. And then after that, we'll see what comes next. Hopefully, sometime by the middle of the year, we'll be able to move around a lot more easily. But it did impact one aspect of the investment market in the United States. It's not as much of a focus for cross-border investors, but there's a tax vehicle called 1031 where you can sell a property and defer the capital gains taxes if you reinvest it right away. That led to a spike in deal activity in December. And it's interesting, the deal activity for December, we had a record December. We had never seen as much transaction activity before in any month. And that's in the middle of the pandemic. But that was because of investors trying to complete those before the Biden administration came in, because there's some fear that tax policy might start to change. We're racking up incredible debts, and there's going to come a point when we're past the pandemic, and at that point, some changes in taxation may come in. And so people are already starting to think about what happens next there.
Okay, good. Just Andy, if we're looking at, I suppose, what's happening in capital, what are you seeing in terms of the Japanese capital?
So, Japanese capital, I was talking to my colleagues before this meeting on the subject. They have a policy when they export, America first, to borrow an expression. And what they mean by that is that the United States market, emotionally, has been a big ally for the Japanese for a long, long time since the Second War. Full of transparency, full of data. The Japanese love to measure things. And also, there's one single language, and there's a single tax regime, right? So Europe, measured against that, is a harder call. We do, I'm happy to say, have Japanese capital coming here. We did a first close on my core fund last October, and in the cornerstone investor group there were my parents, Mitsubishi, and also another Japanese institution. But they had been to Europe previously to see the assets, to somebody's earlier point about visiting. But the Japanese, unlike some other Asian sources of capital, are more prudent, more risk averse in terms of seeing buildings and seeing managers. So I think America first is set for a bit of that still to come.
Okay, and Kim, just in terms of some of the in your conversations or the conversations that you're seeing with capital, what are you seeing in terms of expectations as well, in sort of return expectations with moving cross-border?
I think one of the interesting sets of conversations we've been having is with Canadian capital. Now, Canadian capital has traditionally been very active in its own domestic markets. Please excuse my dog. To move them to get them to move cross border, they recognise that they need to diversify away from their domestic markets. But they tend to put a little bit more of a hurdle on what they want to achieve if they go cross border. So we've heard quite a lot of argument that they want an extra 200 basis points over what they expect to get in their domestic market to take that risk cross border. So we've been spending quite a lot of time talking to them about why they expect that and whether that's a reasonable expectation. I think there's some good, we're finding that we're having some good education with them, talking about reasonable expectations for European performance and what they're getting out of it and how it diversifies their performance, and starting to get them comfortable with the idea that that diversification benefit should offset this sort of expectation that they get 200 basis points. Because, to be honest, if they're looking for 8% in a European market and core plus returns, they're not going to achieve it, and they're never going to diversify.
Just picking up with you, I'm just wondering, Tom, in terms of Brexit, have we seen all of the influence in terms of capital flows? Did that happen kind of already, or are we still expecting there to be some kind of influence from that going forward, particularly for the UK and Europe, Tom?
Yeah, another hot topic. So, I mean, the first thing to say is Brexit definitely affected the UK market in terms of the amount of capital that was being invested. So if you look at the statistics, 2015 was the peak year for investment in the UK, whereas the rest of Europe it was 2019. So it slowed down the amount of capital that was coming in the market, but the UK still remained the #1 market for cross-border investors. So it was still attracting more overseas capital than Germany, for example, but the rate of investment slowed. And that had an impact on pricing growth as well. So if you look at we've got plenty of charts that show pricing for central London offices versus Paris offices versus the German cities, and pricing in those markets has really accelerated ahead in the last 3 to 4 years, whereas in London it was largely static. And that's because liquidity fell. So our liquidity scores showed central London falling from being the most liquid market in 2015 to 16th at the start of this year. Sorry, start of last year, start of 2020. So there was a definite impact, despite what some of the politicians might have said. I remember reading an article in the FT by John Redwood saying that Brexit hadn't had an effect on the market. It definitely has. Moving forward, though, I mean, we've seen some announcements. I think one of the German banks said they were happy to start doing business again in the UK now that we've got a deal. But, the deals, obviously, there's still more to play for in terms of the agreements on the financial side of things. You've seen the numbers about the drop in exports to the rest of the EU from the UK at the start of this year. It's not just like Cornish fishermen who are seeing that slowdown. It seems to be across the board. So it's the agreement is there, and I think it will encourage more investment and more players to come back into the market. But I think longer term, I'm not sure it's such a positive for the market.
Okay, and Andy, in terms of the sort of capital raising, what are you seeing in terms of the strategies which are gaining most traction? What's the capital looking for in that sense? What's working best in terms of the capital raising side?
So there was a move, as in GFC times, towards safety in the last 12 months. So a gentle drift towards core plus and income. Natural in these times, less surprises. That's not the only move out there, and we have good traction with my value add colleagues for investors as we do for the core side. But generally, think flight to safety is the 12-month trend.
Okay, so flight to safety is what you're seeing. And
Just to add to that, Richard,
yeah, go ahead, yeah.
If you look at the INREV Investor Intentions Survey that was published in January, Core and Core Plus had become the most favoured sort of strategy, replacing the value-add and opportunistic, which had been flavour of the month for the previous 3 to 4 years. So that's being borne out in what those surveys are saying as well.
Okay, good. Tobias, in terms of what you're seeing, are you seeing more of a focus on core value-add strategies? And are you also seeing more of a focus, I suppose, on some of the more secondary cities as well? What's your sense of that?
It depends on the type of investor you talk to. When it's, say, the typical institutional investor from Germany or abroad, I fully agree with what Andy said. It's this move towards secure long-term income. Just before year-end, I had a discussion with one of my joint venture partners where we sold a 10-year lease contract with the government of Germany in a location called Bochum. I hope you all ever heard of Bochum, but not that many international investors know that city. We sold it just about a year ago. And we had, just before Christmas last year, we had a discussion. The price we achieved, was it the perfect price, or would this even be higher related to the pandemic? And I say, yes, the price would definitely go up 1 or 2 years rents, because 10 years for refurbished but newly shaped building, this is what investors look for. Also, in March, we started negotiations between a typical German institutional investor and a seller about a big building here in Frankfurt, also with a bond-like tenant. And prices even went up over the pandemic. So as soon as you have a long-term lease contract, that's my impression, investors are still willing and able to even increase prices just to get the building, because that's the issue you have. When you have a product to sell with a long-term income, then price almost doesn't play a big role as long as the investor can just get it. So that's the one experience. And the other is also in relation to our buy and hold portfolio, is that the smaller investors, that they tend to go also to smaller cities for two reasons. The one is they don't want to compete with the big tanks like the Dekas, the Commerz Reals, and Union Investments, but also they have security from another angle. They don't need necessarily the long-term lease contract with a bond-like tenant, but they buy commercial buildings with a multitude of smaller tenants, like a tax accountant, a lawyer, and then you have in multi-resi, you have a building, 2,000 square meters, and with 50 to 80 tenants. It's a lot of work, but you also again have the stable income, and that's the two trends I do not only see in the last 12 months, but for the last, I would say, almost 3 years now.
Okay, good. And Andy, from your side, I mean, there's a lot of talk about, I guess, pent-up demand and a lot of capital being raised at the moment. Do you see this kind of pent-up, I suppose, frustrated investment capital creating something of a mini boom almost as soon as it can? Do you think we're going to see a big pickup in cross-border activity?
I absolutely do. I think that's inevitable, and frankly, we've already got a mini boom in the living and logistics sectors already in the few months of 2021. So what are we, 10 weeks, 11 weeks old? Pricing has really shifted for the core products in both residential and logistics, and that's the valuers moving things as well as the deal guys. So we're on the move, and that mini boom exists.
Okay, good. And just a reminder to everybody, if you've got questions, do please put those in the Q&A. I'll be monitoring those, and I'll make sure that your questions are also answered. And I understand that Andy had not been present before, and you weren't able to see him. So delighted that we can all see him now, and you can especially see him.
Yeah. Just when I said America first, I think something came on the airwaves. I'll try not to be rude about anybody from now, yeah?
Yeah, exactly. You need to be very careful, Andy, from now on. Good. Just in terms of, I'm wondering here, Kim, do you think in terms of the vaccination program, whether that's actually going to have an impact on, I suppose opportunities, but also investors? Are investors looking to see how quickly vaccination is happening and beginning to look at how they allocate capital? Is that is that something that's happening, or will investors just simply wait? What's your sense of that?
Certainly last year what we saw was that investors were keenly following the government responses to COVID. So there was definitely a favouring of places like Germany and the Netherlands, which seemed to act quickly, put in a lot of fiscal support for businesses, protect jobs, and the capital flowed along those lines. And it held back a little bit from the French market, where obviously the French government had a bit more of a challenge. Clearly we saw some the issues in the UK as well. I suspect people will be watching how the vaccination programme rolls out. And certainly, I've heard sentiment that's talking about both the US and the UK seeming to take a more aggressive and rapid action there. And people started to think about, well, when can we come and look at real estate? I don't know whether, and certainly there's concerns that the EU countries are taking too long to roll out rapid vaccination. Whether it will really play out as a reduction in the number of deals done, I don't know. I think that Germany in particular still has some very attractive characteristics, and I'm not sure that a slow vaccination rollout will necessarily dampen very much of that activity. But I think at the margins, people are definitely thinking about it.
I was just going to add something quickly, Richard. I've seen people, some of our clients posting on LinkedIn, sort of various, other heads of research saying that the vaccine program is one of their key drivers in their short-term forecasting. So some people, I think, are expecting that. But then I also heard this morning that the EU only expects to be 2 months behind the UK in terms of vaccinating its entire populace. So 2 months in a relatively slow-moving asset class like real estate might not make that much of a difference. When you look at the numbers at the moment in terms of the vaccinated, the vaccine stats, they look, the UK is a long way ahead of a lot of Europe. But then if we're saying it's going to be a 2 month difference, then that seems to be more marginal than perhaps the data initially suggests.
I think people are going to be a lot more concerned about the economic stimulus in the end.
That's going to be the key driver. That's interesting. I've got a couple of questions that have come in, both interesting ones. One is from Mark. Thanks very much, Mark. For you, Andy, actually, which is in terms of these capital flows, what are you seeing at the moment when we're looking at the French market?
Right. So the French market is definitely dominated by domestics. Now, let's be clear. 2/3 of the Paris market year in, year out remains domestic, even if it's got great transparency and many internationals, such as ourselves, have chosen to set up here and have done successful investments. But the ability to get over the border or not has led to the Groupama's, the AXAs and the others of the world having a competitive edge for the moment in terms of closing transactions.
Okay, and in terms of the sectors and the strategies, anything specific for France or for Paris?
Right. So I guess the unique selling point for Paris at the minute is the giant infrastructure program Grand Paris, which was catalyzed by the coming Olympics even if it's not uniquely about the Olympics. So, the old property truism of infrastructure underpinning capital growth and prospects holds true for here. And beneath our feet, 68 new metro stations are being built. Each one will drive housing, primarily housing. It's residential is the focus of that because there's a housing shortage here as other strong cities. Out of town, obviously logistics. Everybody wants a good corridor of logistics at the minute, and France can absolutely provide some of those.
I just while we're on the topic, I guess of the sectors, are you seeing any sort of from the US particularly? Are you seeing any sort of less of a focus on office as a sector, investors beginning to and capital beginning to be a little more wary of the office market, or has that not really changed so much?
Well, honestly, even before COVID, there had been some patterns underway in terms of investor preferences changing in the office market, moving more towards suburban assets and less towards the towers and the CBD locales. And there were two forces pre-COVID that were driving that. One was a price issue. The pricing of assets, these towers and CBD locations had reached record low cap rates, and there just wasn't enough blood left in the stone for those investors. But then the second issue was demographics. We were poised to see the millennial generation start to move to suburbs. Firms chase workers. The prime working age population was starting to move out to suburbs even before COVID. COVID has simply accelerated that move, with a lot of these millennials starting to buy homes and follow that traditional pattern. So there's a bit more of a focus on trying to figure out whether my workforce, once we can get back to normal, will be a suburban workforce. Will there be demands around CBD locations? Will there be more of a focus around telecommuting? So there's a bunch of unknowns there, and there's a lot of noise flowing around the concepts on it. But the trends that were underway before COVID still seem to hold a little bit more attention towards suburban locations. There's a demographic wave that might support that. So you've got that on the one hand, but then kind of echoing comments from earlier, anything tech related defies all that logic. To invest, you look at what's happened in the S&P 500 and the tech stocks, and the way the FANG stocks have just grown exponentially over the last year. Any building that has tenancies tied to that outperforms as well, and you can see record high prices even in the middle of the pandemic for some of those assets. So then it doesn't matter if it's in a CBD location, suburban location. It's just you're buying not the building so much as the income security tied to Google.
Yeah, no, that's interesting. Just wanted to pick up on something. Thanks very much, Emmanuel, for your question there. Good to see you. What's the outlook for hotel investments in Europe? That's a question from Emmanuel. To anyone on the panel who cares to pick that up. So, does anybody want to pick up that view on hotel investments? So, hotels and leisure, particularly.
Actually, I'm not a hotel profi, but we are currently in negotiations with the owner of some nice downtown city hotels, not in the top 7 locations, but in a strong big city. And we created the idea of just converting these hotels into any type of resi, because my gut feeling is that hotels will suffer. We will in the future. We will not need as many hotels as we thought we would need in the past. So my idea is that some of these outworn hotel buildings, they will definitely be converted into resi or other uses. And on the other side, and that's something a friend of mine who's a developer is focusing on, is touristic hotels, and they will definitely be in favor once the pandemic is not history, but as soon as we can travel again.
Okay, good.
We've definitely seen that in Asia Pacific, that as the virus came under control, that you did see that pent up demand coming back for the sort of the budget hotels that are based on sort of easy and quick tourism, less the hotels that are based around business travel still remains very weak. And I think we've got some real pent up demand for going and travelling in Europe at the moment. So it will be interesting to see how it plays out. I think there may be opportunities to look particularly in the budget sector, and perhaps in some of the more year-round tourist locations as well. But I think that people will be very wary of hotels that are heavily dependent on business travel. So yeah, I think it'll come back, and I think we will see some demand for those assets. And I think there may be some sort of more opportunistic capital looking around opportunities for things like vacant possession to take advantage of that resurgence in demand over the next 18 to 24 months.
Yeah, I mean, for those with an appetite for risk, Richard, I think hotels is an obvious choice. It's one of the few where you might get some genuine distress. You know, the fantasy of distress is always what investors want to hear about, and particularly North American investors. But the reality here is not really that. Why? Because the government is providing comfort blankets, right? You know, the chômage partiel and all the schemes that stop the distress from flowing in. But hotel, I think it'll bounce back, absolutely. I think there's pent-up demand. Look, we're supposed to be a MIPIM, yeah? All of us. Hotels along the front, they're all shut this week. Out of curiosity, I Googled Hotel Martinez. I couldn't get a room. I couldn't get a room because it's shut. And honestly, the pent-up demand for this sort of sensory experience is going to be special for a while. So if you've got an appetite for risk, I do see it as a good option.
You know, there is also an argument in favor of hotels that if you believe that people aren't going to be going back to the offices to the same degree as before, and there's going to be much more telecommuting, you know, for that visceral experience of just getting together with people, that would increase the need for more hotel use, so that, once a month Tom comes in from the wilderness to go to the RCA office in London, and so that would increase demand for hotel nights. So if you believe one hand there, then maybe there's more demand on the other side for hotels. So it could shift that demand around for space.
Okay, good. There was a question came in which has disappeared down the chat, so I will find out who it was from. But that was the particular question there was, if we're looking at Europe, is most of the capital that's coming in, is that for sort of, let's say Western Europe, or is it, or is there some capital, particularly looking at CEE, and is it different? I don't know if anybody wants to pick up that. Tom, I don't know whether there's anything that you're seeing in terms of different pools of capital, Western Europe versus CEE.
Yes. Some of the US investors and the German investors tend to be more active in the CEE markets. Someone like Warsaw, especially, I think, has found favour with some of the German institutional investors on the office side. I think some of them like the prospects for residential there, although it's quite a long-term play. But if you're looking at the most attractive markets for cross-border investment in Europe, where's that overseas capital going? It's largely the UK, Benelux, but primarily the Netherlands, Germany, and France. And that, Spain has been a very attractive market for cross-border investment, but that slowed down very dramatically during the pandemic. Dublin as well is another market that is also, a lot of the German and US funds have been very active there, especially on the residential side. The CE markets, they provide an interesting yield play because you do get genuinely higher yields in some of those markets, but there's an issue. I think there's an issue to do with liquidity, especially in those markets that don't have big, deep domestic investor pools. Which is unlike in the Germany or UK or the Netherlands or France.
Yeah, the flight to safety thing is underpinned by liquidity. Liquidity is the mantra of people who want safety. So It's no coincidence that those four markets that Tom's just mentioned are year in, year out about 80% of the cake. So I agree with what Tom is saying.
Thank you, Andy.
And I'm just wondering, in terms of, you know, one of the issues, I suppose, with investors looking more at beds, sheds, meds, you know, there's much more of a focus on specific sectors at the moment, and alternative sectors where there's actually a limit in terms of the stock. So what does that mean if everybody's focusing on, you know, one area? So the investor universe is narrowing. You know, what does that mean in terms of pricing, do we think, for some of the areas that are most popular and therefore some of the others which are less popular?
So pricing's moved on, as we said earlier, in beds and sheds, no question about that. And people are needing to find their own strategies and not just pop in for any old shed and any old bed. I mean, we have chosen Copenhagen for beds and southern Netherlands for sheds. We have a strategy that evolves around the Blue Banana Corridor. So everybody's got a name for a corridor, right? But the Blue Banana starts at Rotterdam Port and then bends down into Germany and, you know, the industrial bit. That's our strategy. That's how we're trying to differentiate ourselves. To the wider question about what to do differently, I guess alt residential is flavor of the month, things like senior housing and students. But again, you run up against the liquidity thing that we mentioned just now.
One thing on the residential side is a lot of this residential activity has been focused on sort of, you know, apartment buildings close to city centres. And if you know, as Jim was saying, there might be more of a suburban shift, maybe there's an opportunity to shift outwards from city centres into maybe kind of more commuter type locations and provide long-term housing for people in those locations rather than necessarily, you know, 2-bedroom flats for people 2 years out of university, let's say, in city centres.
The key word there, I think, is provide, which means, you know, you got to build it first, and that's something that if you know, with the compression in cap rates, if you can't buy it, you build it. The logistics sector in the United States has a tremendous investor interest for the asset class at the moment, but you just can't buy it. There's just few assets, so there is now a record pace of construction. We've never seen as much construction. Other alternative sectors like self-storage, it's the same story. Not since the data from the early 90s, there's just never as much self-storage underway. So that does, it provides an outlet for some of that capital, but then it raises a question about, well, how much is needed, and am I robbing Peter to pay Paul in terms of just building new assets and taking tenancies away from older buildings? So you got to look at the fundamentals of the leasing of your assets if you're finding what you think is a deal.
I think that income story is going to be really important in thinking about what you buy and where you buy. And certainly in Europe, we're going to face some real challenges in pricing of some things like logistics, given how hot the competition is and how relatively slow and protectionist our planning systems are in terms of delivering new space. So I think we'll see some really pent-up demand there. But I think you have to understand what the occupier is doing with that space and how what the longevity of the quality of that space is, because we have seen big shifts in what people require in terms of eaves height, floor loadings, electricity provision, etc. So you could find yourself paying very aggressively for space that becomes fairly obsolete quite quickly. Whereas I think there's still stories in parts of retail and parts of office where you're still getting good income security. And Tobias was talking about, 10 years to quasi-government or government, that is almost getting overlooked in the sort of charge towards bed, sheds and meds. And yet, actually, the quality of that income is great. And the quality of the building is good as well. So it's trying to make sure you've got your locational longevity from the amenity-rich environments, the quality of the building that will sit in a portfolio for a long time to deliver you that secure income, and the quality of tenants as well, that they will deliver and they will still be there to pay the rent in 3, 5, 10 years time. And I think in some logistics cases you don't have that quality of tenant, and you're taking risks that actually you could buy at a higher yield with a lower tenant risk in other sectors.
Richard, I think there's a scale point going on in logistics which merits talking about. Small lot sizes, right? Micro stuff. You need a lot of square meters, like 50,000 to make a 30, 40 million lot size. Now, in the past, when we've been building our portfolios around shopping centers, 100 million lump, an 80 million lump, a 200 million lump, bang, there's scale, there's size straight away. So what we are seeing as buyers and sellers of logistics is a portfolio premium. So there's scale is what everybody's after.
And that's difficult to access, I suppose, at the moment, in terms of the market. Okay, good. I just wanted to pick up a little bit. There's a lot of discussion there around the home working side, whether or not that's going to lead to more of a focus on secondary and suburban areas. And Tobias, the German market has built up, an element of that sort of micro living because people would be working away or moving. What's your sense of that? Do you think there's going to be more potential to create, I guess, and this is more of a residential play in some ways, sort of larger residential for people who will be working at home and maybe traveling into the office, but far less frequently than they were before? Or do you think things will return to where they were before in Germany?
Yes. That was a very long question. Last year, when we had the first contact ban, I read 2 articles that were totally contrary. The one was from a guy from WeWork saying the office is dead and everybody will work from home, or at WeWork or the Rigas, or who you name them. And the other article was from a guy from Jones Lang LaSalle saying, no, the office is not dead. We will only use it differently. At the end of the day, it was not white or black. We have a gray answer, and also I don't see that moves to the land side because people now say, okay, I don't have to live close to work, so I can buy a house or an apartment in the outskirts of the Taunus area, for example. We have these developments, but I don't see. I'm missing a word. Landflucht. What's the English word for Landflucht? Whatever it is. I think at the end of the day, some people will make use of the situation and do no longer have to work in the office, so they will live somewhere in the green. Others want to live in the city. They still look for apartments in Frankfurt, Munich, you name them. And I don't think that the pandemic was only the catalyzer, but people want to meet people. And when you're on the farmland, you cannot meet with people. Why did Andy look for rooms at Martinez? Because he wanted to be at MIPIM today. Same with me. We, especially as in our industry, we have to meet with people. Not all other industries have to, but I think that at the end of the day, it will not be a dramatic shift to either of these possible developments.
Right. So Tobias, I think Landflucht is like a flight to green and a flight to the countryside.
Yep.
I don't personally buy into that. I buy into urban. And this goes against what Jim said a little earlier about the States. I think in the context of Europe, younger, creative, buzzy human capital is more likely to be living in cities and more likely to stay there. And from a public infrastructure standpoint, it all happens in cities, right? There's theaters, remember them? Theaters, that's where people go to have entertainment, and we're trams and metros, and it all exists there, and we can't afford, certainly now, can't afford the taxes to build tramways out to each and every suburb. So Landflucht is totally understandable. I personally, I believe in urbanization still.
I think that
I
we're
do
going to
believe in
see
urbanization. The challenge is that there's a demographic issue moving against it temporarily in the United States. It's that millennial generation. They're of the age where they're starting to have kids, and it just the urban setting in the United States, the school systems, it's just that natural progression. There is a very large cohort coming in after them, the Gen Zs. A number of the analysts I work with are of that generation in their 20s. And I think once the pandemic is over, they will come back into the cities and experience all the things you're talking about, simply because, and they will want the cities because, from a fundamental perspective, you can't get a date living in your parents' basement. And so you're going to have that kind of revitalization of the cities after that. But, there's a little bit more of the millennials than there are of the Gen Zs, and how that all plays out, still not clear.
I think this is going to be really interesting, because I think this is going to be a real estate trend that plays out very differently in America, Europe and Asia. And it's all to do with cultures, expectations, housing quality, the nature of demographics. So in Europe, the millennials are a smaller generation than the baby boomers. We've got a shrinking workforce. It's a slightly different dynamic to the story in the States, and of course in Japan it's really shrinking now. So I think all that's going to play into slightly different dynamics in the way that we go back to the offices and the way that the office markets develop, and particularly that tension between urbanisation and suburbanisation. I think that's going to be really interesting to watch play out.
Okay, great. We've got a couple of minutes left. So I just wanted to kind of pull it together, really, just in terms of, I suppose, looking at those capital flows, what that means in terms of opportunities. So if we could all spend what is around 30 seconds each, probably, or even possibly 20, on where we think those opportunities are. Andy, let's start with you.
Well, I'm going to go with Paris. I would, but it's all about the Olympics and infrastructure and what that can do for the real estate sector. Secondly, I'm going to go for Berlin, where I have also lived. Now, residential there famously has been tinkered with by the politicians. Artificial rent caps are in place, but actually, if you've got an appetite for risk, I think the odds are that those lids are going to come off. And there really could be something to be done there. And then lastly, coming back to Mr. Mallinson's point about Poland, I think Tom made it as well. The non-domestic, the Polish sector, I think there are probably risk-adjusted opportunities to be had in Polish logistics.
Okay, great. Thanks very much. Tom, what about you?
Well, I just bought a house that's along the Crossrail line in central London. Sorry, which runs across London. So my answer to the Brexit question was maybe a little bit negative, but actually London has lagged behind most other major global real estate markets in terms of its dynamics in the last 3 to 4 years. And so I think there's probably the opportunity for some catch up there. It's always been a market that has a sort of global presence and people want to get into and want to own real estate in London. So I think there's definitely opportunity there. I think tourism hotels possibly. We discussed that in a bit more detail, but I do think tourism will bounce back if you sort of buy into this narrative about the Roaring '20s, which we're going to have this boom period after this extended period stuck at home. I think tourism hotels could be a real opportunity, and then maybe repurposing some of the secondary office stock in good locations to bring it back up to the standard that companies want. HSBC say they're going to ditch 40% of their office stock, and you want to be in that 60% that they're keeping. So repurposing the better quality, repurposing poor quality assets up to grade A.
Okay, great. Thanks very much. Tobias.
Well, I still believe in my idea to buy small business park-like properties in small cities in Germany. Small city meaning 30 to 50,000 citizens living there, with a granular tenant base. So that gives me the secure income. And since I still believe in this, we are about to start a crowdfunding initiative in order to let other investors join this theme. This is the path one, and path B is we are about to start a conversion from an inner city office / production facility into resi, and that's the two paths I would follow these days.
Okay, great, Jim.
Yeah, in the United States, I think that thinking about the best opportunities, in some sense, it's about where is the capital most fearful, and but most fearful without any kind of long-term support on that. Capital is, I think, most fearful around regional malls, and I think that makes sense not to go after that. Something built servicing manufacturing workers in the 1970s and their shopping needs doesn't make any sense anymore. But there's a lot of money running away from urban areas. See, I am actually a fan of urban areas. I do think that there is some demand for them in the future, and so there's probably a little less competition for those at the moment.
Okay, great. Thanks very much, Kim.
It's always hard to go last when everyone else has had such good ideas, but I think my point would be about alternatives. It is a small market, but it's definitely growing, and I think things like life sciences will probably see a lot more stock coming to the market, as a lot of it's in the hands of local authorities, public bodies like universities. They're going to be cash poor and looking to see where they can make money or release capital. So I think we'll actually see quite a lot of that sort of stock coming to the market, and I think there's going to be great appetite for it.
Great, really interesting. Thanks very much to all our speakers. Thank you for your questions. Thanks very much to Simon as well for a really super presentation just to kick this day off. So we've got events coming all week. If you're already registered to RealX, then you can just select those and join them as you wish. Tomorrow we've got a day which is really focused on impact investment and ESG. So there's a mixture of presentations and panel discussions, really interesting topics around that side of things. That starts at 11:15 CET, 10:15 UK, and runs for the day. So do feel free to join us for that. Should be a really interesting session. Thanks very much again to all of our speakers. Thank you for joining us. Enjoy the networking session that runs after this. You can contact anybody who's here. You can also have video calls with anybody, so please do that, and look forward to seeing you either in the networking or tomorrow. Thanks very much for joining us.